Hi, Professor Joe Moreno again. Learning Objective 6 in Chapter 5 talks about financing the purchase of a home. And so a mortgage is a loan on a property. It's a secured loan, which means that when you get that loan, you agree that if you can't pay for it, you will give ownership to the lender. Okay. So you do the same thing with car loans, by the way. It's a secured loan, and so you've given permission that if you can't pay it back, they can come and get the asset. So sources of mortgage loans you can use. I mean, mortgage brokers are everywhere. They take your information, they look for a loan for you. Mortgage bankers are also available. They use their own money, and then they sell that off to third parties later on. But either way, it's important to know that these folks make a living, by the way, by charging fees on those loans because they don't work for free. Um, and that's just something, again, the bigger the loan, the bigger their fee. Okay. So again, they have that interest, like the real estate agents have that interest that they're making money. They make more money when you buy higher property, higher cost properties. So just to know that, that's part of who you're dealing with. In terms of the types of mortgages, there's basically two major ones that are common, something called a fixed rate mortgage and an adjustable rate mortgage. Fixed rate is simply the interest rate on the mortgage stays the same, stays fixed for the life of the loan. Most mortgages are packaged as 30-year mortgages. That's traditional. The 15-year mortgage has been very popular because you get to pay your house down in half the time. I have seen 10-year mortgages, fixed rate mortgages. I've seen 40-year fixed rate mortgages. So they sort of run the gamut, but usually 15 or 30 tends to be the most common of the fixed rate mortgages that are there. Okay. The adjustable rate mortgage simply is, again, it's the same mortgage, still basically a 30-year mortgage, which is traditional. But instead of the interest rate being the same for all those 30 years, the interest rate adjusts. Okay. Um, and depending on the type of what they call an arm, adjustment, based on the type of arm that you get, tells you when they're going to adjust the interest rate on the loan. Okay. So a popular arm is like a 3-1 arm or a 5-1 arm, which basically means a 3-1 arm means that the first 3 years, the mortgage has a fixed interest rate, whatever interest rate they give you. And then every year after that, starting with the fourth year, the fifth year, the sixth year, at the beginning of every year, they're going to adjust your interest rate on the loan to whatever the prevailing rates are. Okay. A 5-1 arm simply means for the first 5 years it's fixed. And then from year 6 all the way to year 30, it'll adjust. The interest rate will adjust. There are some limits on how much the interest rate can be adjusted, usually no more than 2% per year. That's the most, both up or down. Um, so again, when interest rates fall, your adjustable rate mortgage loan rate will fall if it's getting adjusted. Uh, but unfortunately, if rates are going up, then your interest rate on your mortgage is going up, which means you'll have a higher payment. Okay, so those are some basic features there. One of the issues, particularly with adjustable rate mortgages, is something called negative amortization, and that's if you owe, say, $1,000 of interest this month, but your mortgage payment is calculated at like 950. So you're paying $950 even though you owe 1,000 just for interest. So basically, that's negative amortization. Okay, which means that $50 is simply going to be added to the loan. That $50 difference will be added to the loan. You're going to be paying that over time with interest on that. So it's one of those things you got to be wary of. You always want to make sure you're paying at the very minimum the interest on the loan and preferably more. Okay. What should you do, fixed or adjustable? I think basically it sort of depends. Um, a lot of times people today think that interest rates are so low that they're not going to get any lower. And so getting a fixed rate now is a good idea. Some people don't mind living with a little bit of a difference because adjustable rate mortgages often start off with lower rates up front. So they're attracted to that. Okay, lower rate. There are some other mortgage payment options. There are loans called interest only mortgages. So for the first, say, 5 or 6 years, 5 to 10 years, all you're doing is paying interest on the loan. You're not even paying the loan back until, again, it starts after. Graduated payment mortgages work very similar, but they often will result in the negative amortization that was mentioned earlier. Um, Biweekly mortgages are a pretty good option because then you're paying your loan down faster. You're paying every 2 weeks. A lot of people get paid every other Friday, for example. So why don't you just pay your mortgage every other Friday? And basically, that helps build equity faster because you're paying your loan down. And there's something called a buy down. And this is when, say, a builder is building a bunch of houses and they will actually finance. You come and buy it from them and they'll finance that. They'll give you the loan. Okay. So that's just a buy down, what they call that. Most mortgages are conventional, which means it's through a traditional lender and through a bank, etc. However, there are a few special programs out there. The FHA mortgage program is important to know. It's how the federal government is helping lower both the down payment requirements and making sure there's insurance for lenders. You can find out more at their website. And if you're a veteran, the VA also has certain loan guarantees, so it makes it easier for veterans to get a mortgage loan to buy a house. What's not listed on here, there are some actual first-time homebuyer programs per state. So again, that's something you can look up with the state if there's any first-time homebuyer programs for that. Refinancing your mortgage sort of happens after you've had a mortgage for a while and interest rates drop. And so you can basically refinance the loan for a lower interest rate. That's all that is. Okay, a lot of stuff here.